Many of you are probably wondering why I have included 5 strategies and 5 robots in this course. In some of my courses I include up to 100 strategies. You may ask why I don't do one course with a single best strategy so it will be easy for everyone. The truth is that every strategy has periods of profit and loss. Of course, as a general rule, we are looking for strategies that have more profits than losses. However, the losing period in a strategy can last from a couple of days to a couple of months. If you are trading with a single strategy and you hit the losing period, you might be trading for a long time, getting nothing but losses. I was a beginner trader once too. I spent a long time testing different strategies. I would test one strategy in a demo account for a long time, then I would switch to another. Some strategies were profiting, some were losing. One day I realized that I needed to trade with multiple strategies in the account instead of just using one. This way, when one strategy is losing, the others compensate for it. This helps avoid dramatic drawdowns and achieve better results. Now, you might ask why there are losing periods for each strategy. This is because the market changes. It is different every day. There are periods when the market trends in one direction or the other. There are periods when the market is sideways, staying within a range. There are fundamental periods when the market is affected by huge economic events like what we had recently with Brexit. It affected the pound and euro a lot. And there are such events daily which cause the market constantly to move up and down. This is why we cannot expect to have a strategy that profits constantly. The losing periods on the strategies are called stagnations. Later in the course, you will see what an equity line of a typical strategy looks like. The strategies I have included in this course are very different from each other. They have different logic, different entry and exit conditions, different stop loss and take profit, and they are mean for different market conditions. Some of them follow the market trend while others apply to the sideways market. Using these strategies, you will be able to cover different market conditions and you will diversify your risk by not solely relying on one strategy.